The United States just struck Iran. Bitcoin dumped 7% in minutes. XRP slid with it. And right now, across the crypto community, one name and one theory is being whispered louder than any other. Jake Claver's domino theory. The sequence he mapped out months ago: geopolitical shock, oil spike, carry trade unwind, liquidity crisis, and then the phase he called face melting. Is it playing out right now in real time? That is exactly what I am going to break down today. Stay with me. John OG here, crypto analyst and researcher. Welcome back to the channel. Today we are going in deep on something that is moving right now as I record this. Let us get into it. Before anything else, nothing in this video is financial advice. I am not a licensed financial advisor. Everything here is strictly educational. Crypto markets are volatile and you can lose money. Do your own research and speak to a qualified professional before making any decisions. Now, let us talk about what is actually happening. On February 28, 2026, President Donald Trump confirmed what the markets had been fearing for weeks. The United States executed military strikes against Iran in what was officially described as Operation Epic Fury. Within minutes of that confirmation hitting the wires, Bitcoin dropped approximately 7%, touching as low as $63,000 before partially recovering. XRP and most major altcoins followed with immediate double-digit percentage drops. Global equity markets reacted with sharp risk-off moves. Oil markets, as anyone who understands the geography of the Middle East would expect, spiked immediately on fears of Strait of Hormuz disruption. And gold, the traditional safe haven asset, attracted the kind of rapid inflow that it always does when the world suddenly feels more dangerous than it did 24 hours earlier. For the casual observer, the crypto sell-off looked like panic. For the people who had been tracking Jake Claver's domino theory carefully, it looked like something else entirely. It looked like the opening sequence of a framework that one of the most closely watched XRP analysts in the space had been mapping out for months. A framework built not on chart patterns or short-term sentiment, but on macro mechanics, geopolitical reality, and the structural vulnerabilities of the global financial system. And understanding that framework is the most important thing any XRP or Bitcoin holder can do right now. Let me walk you through the domino theory clearly and precisely, because it deserves that treatment rather than a superficial summary. Jake Claver, CEO of Digital Ascension Group, has described this framework as the most important macro call he has made. The theory begins not with crypto at all. It begins with geopolitical instability in energy-producing regions, specifically the kind of instability that puts pressure on oil supply and drives energy prices sharply higher. That first domino is now in motion. The U.S. has struck Iran. The Strait of Hormuz, one of the world's most critical energy choke points, through which approximately 20% of the world's oil supply passes, is now a live risk variable in every macro model on the planet. The second domino in Claver's sequence is what a sustained oil price spike does to global inflation expectations. If oil stays elevated, not necessarily because of actual supply disruption, but because markets price in the risk of disruption, inflation expectations rise. And rising inflation expectations in an environment where central banks have been trying to manage a delicate balance between growth and price stability creates exactly the kind of monetary pressure that starts to unwind the third domino. That third domino is the Japanese carry trade. This is the mechanism that most retail crypto investors have never heard of and that Claver has been warning about for months. The carry trade works like this. Japanese investors, taking advantage of Japan's near-zero interest rates for decades, have borrowed cheaply in yen and deployed that capital into higher-yielding assets around the world: U.S. treasuries, equities, real estate, commodities, and yes, cryptocurrencies, including Bitcoin, through ETFs. The total size of this trade is estimated at multiple trillions of dollars, and it is entirely dependent on one thing remaining true: that the cost of borrowing in yen stays low enough to make the trade profitable. When oil spikes globally, Japanese inflation rises sharply because Japan imports virtually all of its energy. When Japanese inflation rises, the Bank of Japan faces pressure to raise interest rates. When Japanese interest rates rise, the yen strengthens. And when the yen strengthens, the carry trade starts to unwind because the math that made it profitable stops working. Investors who borrowed in yen to buy assets around the world now need to sell those assets, convert back to yen, and repay their loans before the currency move erases their profits entirely. That selling is not targeted or selective. It hits everything: stocks, bonds, commodities, and crypto. Now here is where Claver's analysis becomes genuinely important for XRP and Bitcoin holders specifically, because he draws a critical distinction between how these two assets would behave within the domino theory framework. And that distinction matters enormously for how you think about what you are holding right now. For Bitcoin, Claver's framework, and this is fully supported by what we saw on February 28th, is that in a liquidity crisis driven by carry trade unwinding and risk-off market behavior, Bitcoin faces significant selling pressure. The reason is structural. Bitcoin, particularly as held through U.S. spot ETFs, has become a liquid, accessible risk asset for institutional and retail investors. When portfolio managers and institutions need to raise cash quickly, and a geopolitical shock and carry trade unwind would force exactly that kind of rapid de-risking, they sell what they can sell easily and quickly. Bitcoin ETFs are highly liquid. They can be sold instantly during U.S. market hours. And so in the early stages of a macro stress event, Bitcoin does not behave like digital gold. It behaves like a high beta risk asset that gets sold alongside equities in the first wave of de-risking. CryptoSlate's analysis published on February 28th confirmed this dynamic precisely. Bitcoin's implied volatility was already sitting around 50%, signaling a market capable of large, abrupt price swings. Derivatives positioning had shown a pronounced preference for downside protection, and when the Iran news broke, the selling that followed was mechanical, fast, and driven by risk management rather than fundamental reassessment. Investors who had leveraged positions cut them. Portfolio managers who needed cash raised it. And Bitcoin dropped 7% in minutes, not because the long-term thesis changed, but because in a sudden macro shock, it gets treated as a risk asset first and digital gold later. For XRP, Claver's framework suggests a fundamentally different dynamic, and this is the part of the domino theory that is either brilliant or wrong, depending on how the sequence unfolds from here. Claver argues that as the liquidity crisis deepens, as markets globally struggle with the friction of rapid asset liquidation, cross-border capital movement, and the breakdown of slow, expensive traditional settlement systems under stress, assets designed specifically for fast, low-cost, high-volume value transfer become more relevant, not less. XRP, in his framework, is not a risk asset that gets sold in a crisis. It is financial plumbing, infrastructure that becomes more valuable precisely when the traditional infrastructure is under the most strain. The argument is not that XRP goes up while everything else goes down in the immediate shock. It is that the structural demand case for a fast, liquid, institutionally compliant settlement asset accelerates under the conditions the domino theory creates. When institutions globally are scrambling to move large amounts of value quickly and cheaply across borders, when the old system of pre-funded Nostro and Vostro accounts and slow, swift messaging is failing under the weight of a macro stress event, the asset that was designed from the ground up to solve exactly that problem becomes, in theory, something that institutions reach for rather than away from. Now, I want to give you the honest counter-argument, because this channel does not do hype, and this conversation deserves intellectual honesty above everything else. The domino theory is a framework. It is a scenario. A compelling, well-constructed, logically sequenced scenario built on real macro dynamics and genuine structural vulnerabilities in the global financial system. But it is one possible sequence of events among many, and several of the links in the chain need to hold for the full theory to play out as described. The oil shock needs to be sustained, not temporary. If the U.S.-Iran military action is resolved quickly, without major disruption to the Strait of Hormuz, oil prices could normalize rapidly. If that happens, the inflation expectations channel does not open, the Bank of Japan has no reason to raise rates aggressively, and the carry trade unwind stays manageable rather than becoming a systemic event. The February 28th sell-off in crypto could then simply be a short-term fear reaction that reverses as quickly as it arrived. The Japanese carry trade unwind has been discussed as a tail risk for years and has not produced the kind of systemic crisis that extreme versions of the scenario envision. Partial unwinds have happened, notably in August 2025 when Japanese rate moves created significant crypto volatility, but the full cascading sequence that Claver describes requires a more sustained and severe shock than a partial adjustment. And XRP's specific role in a liquidity crisis, the idea that it becomes the settlement infrastructure of last resort when traditional systems fail, remains more theoretical than proven at the institutional scale required to drive meaningful demand in a genuine macro emergency. The infrastructure build-out is real. The institutional deployments are real. But whether they reach the scale and depth required to make XRP a meaningful demand story during a systemic liquidity event is a question that the current state of adoption cannot definitively answer. Here is what I think matters most for XRP and Bitcoin holders watching this right now. The Iran situation has introduced a genuine macro variable into an already complex and fragile global financial environment. The domino theory's first domino, Geopolitical stress in a major oil-producing region is now unambiguously in motion. That does not mean the full sequence plays out, but it does mean that the risk of the sequence playing out has moved from theoretical to real in a way that every serious investor needs to factor into their thinking. For Bitcoin holders, the honest assessment is this. In the short term, under continued macro stress, Bitcoin faces selling pressure driven by risk-off behavior, ETF outflows, and the carry trade dynamics that Claver describes. In the medium term, if the macro environment shifts from inflationary shock to recessionary outcome and central banks move toward easier money, which CryptoSlate's analysis identifies as the second stage of Bitcoin's likely response to a US-Iran conflict, Bitcoin's recovery could be significant and rapid. The asset's long-term thesis remains intact, but the path through a macro shock is not straight up. It is volatile, uncomfortable, and requires holding conviction through drawdowns that feel very real in the moment. For XRP holders, the honest assessment is different and arguably more complex. XRP's short-term price behavior is subject to the same macro selling pressure as every other crypto asset during a risk-off event. But the structural case for XRP, built on institutional adoption, tokenization infrastructure, ISO 2022 compliance, the OCC Trust Charter, the deployment of major European banks on XRP Ledger, those fundamentals are not altered by a geopolitical shock. In some versions of how this macro story develops, they are actually strengthened by it. A world where the fragility of the existing financial infrastructure becomes visible and urgent is a world where the case for better financial infrastructure becomes impossible to ignore. The face-melting phase that Claver describes, the moment when the sequence of macro events resolves into a rapid, violent repricing of XRP and related assets as their utility becomes undeniable to institutional capital, that phase, if it comes, will not announce itself politely. It will not wait for retail sentiment to turn positive. It will not give people comfortable time to position. The entire point of the framework is that by the time the face-melting phase arrives, the positioning window for patient, informed holders will already have closed. Whether we are truly at the beginning of that sequence right now, whether Operation Epic Fury is the first domino in the chain that Jake Claver has been mapping, that is genuinely unknown. What is not unknown is the quality of the research behind the framework, the structural reality of the vulnerabilities it identifies, and the importance of understanding it clearly enough to make your own informed decisions about what it means for how you hold, how you think, and how you prepare. That is the breakdown for today. As always, nothing I have shared here is financial advice. These are my observations, my analysis, and my honest assessment of a framework built by someone else that I think deserves serious engagement. The situation in Iran is developing in real time. I will be tracking it closely and bringing you updates as the picture becomes clearer. If this video gave you a sharper understanding of what is happening and why it matters for XRP and Bitcoin, please hit the like button. It genuinely helps this kind of serious analysis reach the people looking for it. Subscribe to the channel and hit the notification bell so you are here for every update as this story develops. Follow me on all social platforms, links are in the description, for real-time thoughts between videos, and drop your perspective in the comments. I read every single one, and right now, more than ever, the conversation matters. This is John OG. Stay informed, stay calm, stay rational, and I will see you in the next one.